Hey, Steve Saretsky here. As always, there's a couple blog posts to go with this. I just want to touch on a few things, some changes, some shifts in the credit lending interest rate environment. Obviously today, Wednesday, July 12th, Bank of Canada hiked their overnight interest rates 25 basis points to now 0.75, so basically falling in line with the U.S.'s Federal Reserve. So this is the first interest rate hike by the Bank of Canada in 7 years. I've talked about this multiple times, how we're in this basically test environment, historically low interest rates. They've never been this low in history. A giant test by central banks here. And the Bank of Canada, despite all their measurements, all the readings for inflation are below target. In Q1, 3.7% of our GDP growth, 3.5 of that was from housing. Oil slumping. Basically every metric that signals the Bank of Canada probably shouldn't hike. They're doing so anyways. I've talked about this before. Is they got to get these interest rates back up. I mean, you can only keep it at the zero lower bound for so long. I would, a lot of people argue that they're actually tightening for the next recession, so they can then cut them again. Obviously, currently in the United States, again, when the U.S. sneezes, Canada catches the cold. So the economies are very much aligned. It's the second longest bull run for the U.S. without a recession. Again, it's usually a 6 to 8 year window with business cycles. So the Federal Reserve is fully well aware that a recession is due at some point. Whether it stretches out another year, maybe two, but they got to get them up again. The average interest rate cut in a recession is 4%. So they're trying to get them up. That's why the Bank of Canada has followed suit with the U.S. again. I mean, you can interpret how you wish. That's how I certainly interpret it, and that's what I believe. Maybe you can argue the data is good, but anyways, regardless. That's neither here nor there. Interest rate hike is increased. It does have some impacts on the Vancouver real estate market. Particularly variable mortgage rates. As soon as the Bank of Canada hiked their interest rates, the big three banks, RBC, I believe it was TD, and BMO, have now all increased their prime rate by 25 basis points as well. So it went from 2.7 to now 2.95 is what you're borrowing at. So, obviously for anybody that's coming in to get a new mortgage, it's not a big increase, but of course, obviously as interest rates get higher, it ultimately reduces your borrowing power, and thus, again, to sustain higher prices, the borrowing power has to be there and whatnot. So, and then you can say, okay, well, maybe if interest rates are increasing, do I go to the 5-year fixed? Well, the 5-year fixed has also been increasing substantially over the last couple of weeks, because basically it's tied to the Canadian 5-year government bond yield, which I've talked about, and that has almost doubled in the last couple of weeks. Basically investors have been pricing in that the Bank of Canada was going to hike interest rates. Of course, they followed suit. And so I think the lowest 5-year on the market today, from what I see, is HSBC, which was at 2.39. Now, from what I understand, is they're actually going to be increasing as well. So certainly that mortgage rate increases are on the rise. It's believed the Bank of Canada will hike again in October. I mean, again, it's all speculation. I don't want to. I would say don't make any movements or decisions on buying a home based on if or not Bank of Canada is going to hike in October. It's anyone's guess. They can switch on a dime, as they did, just recently. They were very, very pessimistic about hiking interest rates, and all of a sudden over the last couple of weeks they said, yeah, we're going to hike them. So it sort of came out of the left field. I wouldn't be surprised to sort of see them reverse course, because again, I just don't think the economy is really that strong. If you look at all the fundamental data that they normally look at to hike interest rates. So that's sort of where we're at. Higher interest rates are coming. I would expect them. I don't know. Again, the people that are saying that we're going to get some sort of normalization in interest rates, where you have the overnight interest rate go from right now at 0.75 back up to 1.5–2%. I just don't see it happening. I think they might get in a couple more hikes, but it's hard to sustain when you have such minimal growth, and of course the high interest rates, or sorry, the high amounts of debt in the system. And just to touch on that, so I think another big move here is, again, I wrote a post on this on my website, so you haven't checked it out, mancitycondoguide.com. But perhaps the bigger thing than a 25 basis point increase in the interest rates is really OSFI, which proposes a lot of the lending criteria, has actually proposed a 2% stress test on uninsured mortgages. So uninsured mortgages is basically anyone that's going 20% down or more. Those are considered uninsured mortgages. They're now proposing a stress test on those. And so basically, if you looked at it before, is okay, so the Canadian government, they introduced a stress test back in October of 2016 on insured mortgages, people that are going less than 20% down. They said, okay, if you're doing that, you're going to get stress tested at 4.64%. So obviously, even though you're borrowing at 2.5%, or whatever the case is, you're going to get stress tested at 4.64%. So obviously, that significantly reduces borrowers' capacity to get the biggest mortgage that they can possibly get to actually compete in the market. So what they were doing is they were bundling loans from different sources to get up to 20%, to then avoid that stress testing. So what OSFI has now proposed, and it's believed that it's going to get implemented in August from variable sources in the industry, is they're going to ban bundling loans, as well as a 2% stress test on uninsured. So whether you're insured or uninsured, it doesn't matter. You're going to get stress tested regardless. Again, many people believe in the industry. One of the good guys I follow is Ben Rabideau at North Cove Advisors, who studies the whole Canadian banking industry. Of course, they even had Equitable Group on there, which is a private lender or alternative lender, who said that they believe it's going to be implemented. And that's a pretty big chunk of their business. I believe they were saying it was about 10%. So I would say that's almost, again, because most people don't really understand it, it's actually, in my opinion, it's probably a bigger play than the Bank of Canada's interest rate hike. A 2% stress test on any mortgage, which, again, I believe it's going to be implemented. I think that August 17th is the date. It might not, but everybody within the industry believes that it will be. So I would argue that that's a bigger thing. So, I mean, you got that, and you got the Bank of Canada hiking interest rates. So there's a lot of tightening, it looks like, in the lending standards moving forward. Of course, we've seen mortgage-backed securitization in the it's dropped quite a bit. I'll see if I can post a chart to that since all the woes at Home Capital Group. So investors have backed off a bit from that. And again, that all comes back down to funneling mortgages, and again, as prices increase and wages are stagnant, a lot of it is predicated on mortgages continuing. They have to funnel in more mortgages and more leverage ultimately to keep things escalating. So very, very curious to see how that plays out, how it plays on the psychology of local buyers. I think that some of the more savvy buyers, I guess, maybe the older ones that have sort of been around a while, that understand the ins and the outs of interest rates and whatnot, I think are a little more bearish on it. And I think that you have sort of a younger generation that doesn't really think much of it, and so it's interesting to see how it plays. I think some people are sort of running for the hills, trying to also lock in rates before they go up. So I think you sort of have two different camps here. So it'll be interesting to see how that plays on the psychology of the real estate market moving forward. But again, obviously, reducing the borrowing capacity of borrowers and ultimately buyers does have impacts on the real estate market and on prices. So that'll be something to watch for. Maybe it slows down the acceleration of price growth. Obviously, again, I've talked about condos that have just been increasing astronomically over the last 6 months. So this is going to take some time to play out. Obviously, again, it's just a Bank of Canada rate. It's a very small rate hike. They're talks they're going to do more, but I don't know how far they're going to get. So anyways, that's my little thoughts on the market today. A little bit of credit tightening in the system, things to watch for. And hope that helped.